Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the stock market. We're going to be taking a look at things like the corporate bond market, talking about surging inflation, a huge amount of concern regarding a decelerating economy and an incoming recession. Apparently, this would be the most anticipated recession in history if it were to play out. So, of course, there's a huge number of concerns in the market right now, a huge number of things to be very concerned about in the stock market. But of course, we know that the market is designed to trick us. It's designed to bring a maximum amount of pain to a maximum number of investors. So we want to approach this with a contrarian mind and keep in mind the fact that the market rarely does what everyone expects it to. So predicting the market is incredibly difficult, but we try to do it anyways. If you're interested in following these crazy markets with us, make sure to smash that subscribe button and also click on the like button if you enjoy this episode. We do take a lot of time and put a lot of effort into this research, into putting out these videos for you guys. So it is greatly appreciated. And now without further ado, let's get right into it. So I wanted to begin by taking a look at the junk bond market and how it can actually help us to understand the market in a deeper manner, right? When junk bonds are showing strength, that tells you that market participants are perhaps ready to take on more risk and that they're more confident about the future of the market. And a perfect example of this is when you have divergence between the high yield bond ETF, JNK, and the stock market. For example, here, right before the COVID top, you had the market make a higher high and the junk bond ETF was making a lower high. And the same thing happened right here. Look at this. You had higher highs leading up to that January all-time high on the stock market, but the junk bond market was telling you that investors were stepping away from these high risk assets and that you were likely to see some type of a risk off move here. So what does this move mean that we saw a couple of weeks ago? We saw a huge strength in JNK. Now, obviously, some of that gain has been given back here, but junk bonds are still relatively high. So the question we're trying to answer here is, what does this mean for the market? This is clearly a change in character. This big breakout that we saw is clearly a change in character relative to anything we saw throughout this entire period, throughout 2021 and even 2022. So what I did is I took a look at the rate of change on a 9-day period here. This is the rate of change. So it tells you basically the momentum of the move that you're seeing over the last 9 days. And so you can see that we did have a pretty big spike here. If we zoom out, you can see I've highlighted every time that happens. Let me just put a horizontal line here, and you can see all these vertical lines correspond to that type of move. You can see over the last, let's call it 10 years, we've had 6 readings, not including the one we had a couple of weeks ago. And so if we've superimposed the S&P on this chart, and we take a look at how markets perform following these readings, it was exceptional. These readings often corresponded to the very beginning of moves up in the market. Look at 2016, 2018 again, and 2020 again, obviously, very, very beginning of a move up. And if we zoom out even further, you can see this is also the case for 2011. Right before this major run, it marked the very bottom of the 2009 financial crisis. And you had a couple of readings here during the crisis, right after the big crash in 2009 and right here after this bull trap. So that's a very promising development here. Seeing strength in the junk bond market is definitely good to see. But of course, we need to keep in mind the fact that we have this bias of just seeing the data from a bull run. So of course, with everything that we take a look at, no indicator is perfect. Nothing is going to give you 100% accuracy and 100% predicting value. So, this is all about probability, and that's the game of being in the market. And these can be very promising results, but it doesn't guarantee that you're going to see upside, right? For example, in these 2000 2009 readings, you did see the market continue to collapse in the months that followed those readings. So now, is the fact that we're seeing this move back down here, is that a problem? Does that negate this thrust that we had? It could, right? It could cancel that reading. For example, if we go back to those 2009 readings and we take a look at junk bonds, these were whipsaw readings in the junk bond market. So if we want to really use this reading as a bullish signal, we want to see junk bonds continuing to outperform. If we start to see junk bonds come back to the lows and crash down here, that wouldn't be good for the market. It would cancel that bullish reading. But seeing it give back a little bit of room before continuing higher, that is 100% to be expected, right? And for example, look at 2011. You had that reading right here, right as the market was rallying off the bottom. And then you had a little bit of give back period for a few weeks, which did correspond to a little bit of market volatility before eventually the market resumed higher. So these are all nuances and things to keep in mind with this very promising results of strong performance in the market following a thrust in the high yield bond ETF, suggesting that market participants in this instance, in that week, were ready to take on risk in a manner that we haven't seen since 2020. So that's definitely something to note and keep in mind when forming our opinion on the market. And look at the strength of that on this weekly chart. This is one green candle. This is what you call a bullish engulfing candle that engulfs 1, 2, 3, 4 of the previous red candles. It retraced 4 weeks worth of trading in just 1 week. So that's incredible strength. We want to see that follow through if we want to stay bullish on the market in the short term. And we actually took a look at this from a completely different angle by looking at the high yield spreads. When you have a tightening of the high yield spreads, basically this indicator goes down. That's tightening of spreads. So that's the equivalent of junk bonds rallying. And you can see what happened the other week is we had a big tightening of the high yield spreads. And if you look at what S&P 500 returns look like following this type of tightening in spreads, in the 6 month that follows, it leads to incredible gains on the S&P 500 relative to historical averages. So that's just another way of proving that that is a bullish signal. Now it does need to materialize and it can always become an exception, and that is something to keep in mind. And it's also interesting to see that type of development in the context of huge underperformance in corporate bonds. This is an interesting chart that highlights the fact that corporate bonds have been underperforming for the past year in a similar fashion to what we saw during the housing bust and the 1973 recession. Now, I haven't rechecked the data, but I found this chart interesting. But this reading here occurred at the bottom of the 2009 crash, and this occurred at the bottom of the 1973 crash. That doesn't mean we're heading into a 5-year bull market, but it perhaps suggests that there's been a huge amount of fear, a huge amount of concern, especially when you take a look at the current sentiment right now in the market, which we're going to talk about in just a second. But that does paint somewhat of a contrarian and optimistic outlook for the stock market right now. So that's definitely interesting to keep in mind. This technical posture on the S&P 500, it's just at such a pivotal moment here. We had this bounce. The market was very, very oversold here. So we were due for a bounce. We didn't expect the market to collapse, but now you're no longer oversold. You've worked through those oversold conditions. And really here, you're at a point where from a technical standpoint, it could go either way. There's no edge from a technical standpoint. You've got this big neckline support here that needs to be held for the short-term structure to remain bullish, right? This was a big bullish development. This was a false breakdown. Objectively, that's bullish, but we need it to hold. If we come back below, that's bad news, and we're very likely going back to the lows. And on the other hand, you've got this head and shoulder pattern forming here, inverse head and shoulder, that's telling you that if we break out, well, the market could have quite a bit of a runway in the short term. So that's a very pivotal moment. You can see the shoulder, head, and another shoulder here. If that breaks out, that confirms the pattern and we move higher. Now, to really understand where the market is heading now and to provide additional context regarding everything that's going on, we can take a look at this article that was posted on the 23rd of May. I believe that's the exact moment the market bottomed. And we can take a look at this chart that we made on the AAII bull bear spread. And again, very similar. You can see here the bull bear spread. So the spread between the number of bulls in the market versus the number of bears. So essentially the market sentiment, it was very low a couple of weeks ago, in the bottom 5% of readings since 1987. And so if we take a look at how the SP 500 performs from those readings on, from those 5% readings, the average return 1 week to 6 months out is significantly more elevated following these readings than at any other moment. So that adds context to everything that's going on right now. And if we put a 20-day moving average on this chart, you can see sentiment over the past few months has come down to incredibly bearish levels, something we really haven't seen ever except in 1990 at the very bottom of this correction. So I'm not saying we're going to head into a 10-year bull run here, saying that we're coming out of a very, very pessimistic and skeptical environment where too many investors are looking for downside. That typically takes time to work off those conditions. And I can show you, for example, in 2008, right here, we had a very similar type of crash in the sentiment. And this was before the big crash, right? So that's something to keep in mind. This was before the big part of the stock market crash, but you had this reading and this precisely led to a significant bottom and then a rally for 6 months. We've only had a rally for around a couple of weeks and sentiment has not recovered whatsoever. So perhaps we need to wait a little bit longer to see if this is perhaps a bottoming process that's occurring right now, or if we can expect the rally to strengthen. And keep in mind, these charts were made on the 19th of May. This article was posted on the 23rd of May, right as we had a lot of skepticism in the market, right? Small trader put call premiums were sky high here. So many people were looking for downside. Now, does that mean that all of these indicators are perfect? Absolutely not. You're always going to have exceptions in these indicators, and this is probability analysis. And that is something that we have to live with if we want to be involved in the market. By the way, if you want to have access to these articles, we make these frequent updates on the market, taking a look at the technicals, the sentiment, valuations, big signals that we're getting in the market right now, and what kind of opportunities we have, and also what's going to fundamentally drive the market right now. One of the big things that we're looking at right now is oil, because oil, according to a lot of the research that we posted this week on the website, is giving us a lot of insight regarding where inflation could be going and what that means for equities. So over the next few weeks, we won't just be looking at this technical posture and how it resolves itself, but also what's going on oil that does seem to be wedging up here in this bearish rising wedge here, and bond yields that do seem to be stabilizing over the last few weeks, because these are really the big driving factors of the market and are going to determine where we see stocks going over the next few months. So if you want to stay updated on that, make sure to go and check out our website at gameoftrades.net. So that's about all I wanted to cover in this episode. I hope you guys enjoyed this one. If you did, make sure to click on that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.